Hey guys, my name is Mark. I'm a retirement planner in Ontario, Canada, and today we're going to be going over pension income splitting and how important it is when it comes to taxation. So, this couple came to me and they said, "Hey, look, Mark, we have a defined benefit pension, RSPs, normal Canadian family, and there's a lot that goes into this plan. This is a software called Snap Projections, which I use to help people model people's financial plans. But today the topic is just going to be pension income splitting." And what that means is if you have a pension and your spouse does not have a pension, or they have low RSPs, they don't have a lot of registered taxable income, it might make sense for the higher income spouse to split up to 50% of their income with the lower income spouse to effectively lower your tax bracket. You're going to be taxed a lot more at 100,000 than you are at 50,000. Whereas if your spouse is making $0, you could, in theory, split up to $50,000 of your income to them and essentially lower your taxes. So that's exactly what happened with this couple. In this case, the wife has all the RSPs, all the pension, and when that RSP turns into a RIF, you can start splitting the income. So what we do, and I'm going to show you the difference at the end, it's very dramatic. So we have the pension and we have the RSP/RIF. So once the spouse hits 66, the pension, after they stop working, the pension income starts turning on. So we're actually splitting $47,000 of income to the other spouse because he has essentially no income. So all he has is CPP. And because he only has CPP, it makes a lot of sense to transfer all of that RSP and pension income to him. And when you actually look at the results and I compare these scenarios of no income, no pension splitting to pension splitting, overall in lifetime personal tax, they pay $114,000 less dollars. They get minus $44,000 in OAS clawback, which means they keep $44,000 more dollars in OAS because the wife doesn't have all the income, therefore her income doesn't get clawed back, and they actually end up with a lot less tax on their estate because as you melt out that money, you can place it in your RSP, and overall, I would say the net worth improvement of this plan, conservatively, you're looking at $300,000 to $500,000, and that's just from one lever. So making sure that, yes, okay, we're doing pension income splitting, sure, that's pretty, I guess most people understand the idea behind pension income splitting. But when you talk about CPP timing, combined with pension income splitting, combined with OAS timing and OAS clawback avoidance, as well as maybe melting down an RSP a little bit early to shuffle some of that money into a TFSA if you have TFSA room, overall net worth improvement, you're looking at $400,000 to $500,000 over your lifetime. And that's just from doing a few simple moves. Keep it simple. Keep it simple, right? If your situation looks at something like this, you're wondering whether you want to take CPP early, CPP late. If you have any of those financial planning questions, there is a link to my calendar in the bio. There's also free resources on my website that you can use, CPP checklists, all that stuff, which I will link in the bio as well, or I guess in the description. This is one of my first videos, so bear with me. And if, again, this is a specific example, contact your financial planner, ask these questions, and make sure that you plan for this stuff so you don't get blindsided by it. Okay, Mark from Calm Wealth, and I look forward to you living a fruitful retirement.